Welcome everyone to Almus Market Mornings, your daily dose of global financial updates. Going into the day, let's discuss one of the most tracked numbers around the world, the US CPI. The US CPI came in below market expectations, which acted as a pleasant surprise for the risk assets. Equity saw a good jump, while in the world of currencies, we had some weakening in the dollar index. Now, whether these will further strengthen the narrative of Fed being less aggressive going forward with their rate hikes is something to be seen. But there was definitely some celebration by risk asset holders. JK, good morning. The question I want to ask you is that a few days back, we saw a bumper NFP number. Yesterday, we saw a cooling inflation number. What is your sense of these data sets, and what would be the Fed, look at more keenly?
Yeah, definitely, Swaraj. In fact, it was really a very good morning in US as retail inflation decelerated coming in after the blowout jobs report on Friday and aroused the talks of Fed achieving a soft landing. That's the key. Is Fed achieving the soft landing? US stocks rallied after the inflation decelerated and prompted traders to splash Fed rate hiking bets. Wall Street is now anticipating Fed pivot in September as pricing reflects a half-point increase as against 0.75, which was being priced in just a day ago. Significantly, Nasdaq just rallied 20% in 55 days, which is making a lot of traders to abandon the idea that this is a bear market rally. The tech-heavy index is, of course, still in bear territory, more than 20% lower from the highs, but the clearing of the key 200-day moving average at 12,930 sustainably will put it back out of it. I'll just come to your question, Swaraj. What about the data itself? It was an all-round downbeat number compared to expectation, which itself was actually below previous month. Food and oil prices contributed heavily to the decline, while even moderation in the rentals was significant. Should be noted that oil prices have continued to fall in this month too, and therefore staying below 100 in this month would again be pulling down the CPI number. So that is what the Fed will be looking at. And more evidence of it, they will look at the core PCE number, which will come later in the month. You should also know that Fed has a lot to chew before the next meeting on September 21st, like PCE core prices, which I said, and then the jobs number, and next month CPI as well. So the big question is whether these price trends will be sustainably lower bound. But let's understand that lots of drivers of higher inflation are not in play now. Fed is tightening, quantitative tightening is ongoing, and thus money supply is reducing. Supply chain issues are easing. Consumption itself has slowed, which means the demand is low. All these were earlier contributing to higher prices, and now they are not in play. At least they are coming down in their influence on the prices. This is what the Fed will continue to observe through the data, which will come out in PCE numbers as well as on the consumption numbers going forward. Of course, jobs market, if it remains strong in the face of this lower inflation going forward, actually people may start saying that we have a Goldilocks scenario, lower inflation and better growth. So, but that's too early to say. But it's even too early to say for what Fed will, approach with in the next meeting, because there's a lot to chew before that. Yields also dropped in the short end yesterday, and therefore the 2 to 10 year yield difference narrowed down a bit. What also tempered the rally in bonds and stocks was some of the comments from Evans as well as Kashkari, who had long been known as on the dovish side, but now Evans is actually hinting at 4% rate, terminal rate, and he was saying 2.5% not too long ago. Kashkari was a long time dove. After the CPI details said that the Fed is far, far away from declaring victory on inflation. There was also a Wall Street Journal report saying Fed likely to want further evidence of inflation slowing down. Easing in price measures pressures last month followed reports of stronger than expected wage growth, complicating the rate setting outlook. So it's still not given, but yes, it's a big relief. So let's go to the dollar. See the dollar. If you look at the dollar's performance since last week when we had that tremendously strong US jobs number, dollar hardly rose more than 1% against, perhaps yen reacted a bit more at the time. But generally, if you look at EM currencies, they were in the range. Euro held well above 1.0150. Similarly, Aussie dollar, etc. But when we had the soft CPI number, the dollar has fallen quite a bit, and particularly against the underowned currencies like euro, GBP, and yen, who have been sold across for quite some time now, and they had the biggest rallies in yesterday's. So I'm saying it's not only the fundamentals which are on the verge of reversing for the better, but also the positioning which is getting downsized now. The long dollar positioning is getting downsized. That's why you are seeing the impact on these pairs. In fact, Aussie dollar rallying uh, above 7,050 is really a early indicator of a risk sentiment, going positive. Uh, Only currency which has underperformed is Chinese yuan because of domestic problems. Rupee, of course, we did have heavy tone to it at 79.60 levels. It was some rumored flow of fundraising by a bank, apart from exporters also getting into the act yesterday, but definitely the data provided the push lower for the USD INR towards 79.05 overnight. Uh, I think if we get more good news on the inflation front and on the rates front from the US, USD INR is more likely to retest 78.50. But don't take it as a straight line move. Definitely, we'll have to take one step at a time. But definitely, my sense 79.50 and above is now getting a good area for selling for next 1 to 2 months. Then we will take after that how the domestic economy, inflation, and trade deficits pan out. I guess too early to say that rupee has reversed, but definitely, combined with the fact that lower oil prices and flows from FIIs give us a feeling that rupee might have seen the worst for now. When I say for now, maybe I take it as 3 months. Then we'll take it forward after that. Thank you.
Okay, JK, thank you. That was very interesting. And so a statement you mentioned I want to touch upon is that we had some known during this like 1 2 years, past 1 2 years, we have had known hawks acting as doves and known doves acting as hawks. So very interesting.
Absolutely.
As JK mentioned, a day before we had market pricing in the 75 basis hike. Now we are having increasing probabilities of 50 basis hike being talked about. Uh, as we keep saying, manage your risk as such stories keep changing based on statements and numbers. That's it from our end. Thank you. We'll see you all tomorrow.